Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Part of my monthly routine to get another source of cash flow is to use options, specifically selling put options for cash premiums. I sell them the first week of every month to expire 6 weeks later, the third Friday of the following month. I had the opportunity to present my process, including the live selling of the puts to a group, and I recorded it. The recording is split into two parts. I hope you will find this look over my shoulder informative. Please note that options are risky and should only be used by informed people. Also note that I have the resources available to take possession of the stocks should they be assigned to me, hence the large dollar amounts involved. If you do not have the cash available, you can either buy back the options, which I will explain in the video, sell the stock as soon as it is assigned to you, or use smaller dollar amounts, or just sell fewer options. This is part one. Please see the video links at the end screen of this video for part two.
When you're doing the puts, basically what happens when it expires worthless?
So I'm selling them.
Right,
So my goal is actually to have it expire worthless.
right. Does that mean you actually buy the shares then?
Well, if it's in the money, meaning not expiring worthless,
Yeah,
what I will do is I'll take possession of the shares because the shares were up here. I sold the put with a strike price down here. I made cash right off the bat. If it went up, great, expired worthless. If it went down, it went down for uh to a price that I would have bought it at anyways,
right.
right?
So basically, if you want to buy shares of that company, then this is a good way to do it.
It is. So for example, a couple of months ago, Bank of Nova Scotia got a new CEO, which the market didn't seem to like. So I'm at the gym on my phone and I'm like, oh, Bank of Nova Scotia dropped 4%, let's say. When I get home, I'm going to buy Bank of Nova Scotia. But I already have a whole bunch of Bank of Nova Scotia and I'm like, well, if you're just going to buy it outright, just sell a put,
Yeah, exactly. Okay.
right? You'll get cash for it. You'll get a slightly better price than it is today. And if it goes down further, well, if you had bought it outright, you would have held on to it anyways. At least that's my philosophy. And as a result, selling a put is a no-brainer.
Yeah.
Okay, so what you're going to see me do today, and it usually takes about 2 hours since you're the only one. I'll check in to see if there's anybody else, and if not, we'll just sort of
Okay.
we'll sort of end it. But do ask all the questions, and so what I do is I do it once a month. I do it 6 weeks out because during that time, the theta, the time value, drops the quickest. And so where I'm benefiting is with the theta decay.
Right.
So I don't do it 3, 5, 6 months or anything like that. It's just 6 weeks. I sell the third Friday of the month expiries. And so going back to me taking possession of the shares, I sort of missed a little bit of that maybe in the previous meeting. Uh, I'm able to come up with the money, right? That is the difficulty, is because if you happen to get caught in a bit of a downward trend, you could get a whole bunch of stock. Now you're saying, well, hey, I got a cheap grade, but having to come up and I'll show you, $50,000, $60,000 isn't the easiest thing. So what most people would do, and especially if you're planning on going into options trading, they want no part of the shares. They will buy the puts back. So let me share my screen and I'll kind of show you, maybe
Okay.
repeat, and feel free to ask questions. Okay, so stop sharing and okay. So okay. And so here's my portfolio in interactive brokers. And up here we have the puts that I had sold, right? They show up as a negative because I sold an obligation for myself. I got cash and now I have an obligation. Um, and down here is the actual share positions. So what you can see here is, so for example, Algonquin. The share price, sorry, the strike price is 10. The share price is $9.32. So it's in the money. Um, Now I sold it for $214. I could buy it back today and get out of the obligation and never get the shares if I paid out $413. Now, it, because of the time decay, because I sold these a month ago, because of the time decay, this is actually better than it would have been otherwise. Because if the shares had moved this much, but a month ago, then this market value would have been a bigger negative and I would have had to shell out more. But because time has gone away, uh, I would still be negative. I would still be negative on the trade for $215, but I could get out of it if I could not come up with the 5 grand, right? Five contracts, five, which means 500 shares. 500 times 10 is I'm gonna have to come up with 5 grand in on January the 20th. So you don't actually have to take possession of the shares. Just so that's clear. The other thing that so this is a very simple version that I'm doing. What uh, actual options traders do is that they don't leave themselves exposed, because what could happen here is Algonquin could keep going down and I would be obligated to buy it still at $10 a share, or I would be having to pay whatever the market value is, and of course that would keep increasing as the shares kept dropping. And so what real options traders will do is they want no part of the shares, but what they will do is they will also cover themselves by buying a put further down in price. So let's say I'm making this up, but $9 strike price or $8.50 strike price, to prevent a catastrophe with Algonquin going to $5 and them still having to buy it for 10, or pay out a huge market value, which this option would take on as the price kept going down. So just to be clear, the if you didn't get that, I'm happy to repeat. The other thing I should mention, since you haven't set up your margin account and so on yet, is you're getting yourself educated. You're reading about this and all that, which I think is important. When you're filling out the forms for the brokerage in order to set up the margin account and get the permissions for the options, um, the form will say, are you beginner, intermediate, or expert? If you say I'm a beginner, all they will let you do is sell covered calls on existing stock positions that you own. So you will not, for example, be able to do the put selling. Uh, so if you do feel, and I'll obviously fill out these forms truthfully, if you do feel that you're experienced enough with options and want to be able to do whatever you want and not have the brokerage save you from yourself, then put that you're an expert, and you'll be able to do anything. But of course, also harm yourself financially if you do bad things. So since you haven't set it up yet, be aware of that, because I filled out the forms and I said, yeah, I'm beginner or intermediate when I did it 2 years ago, and it didn't. They basically, I didn't have permissions to do most things, and then I had to do it again, fill out the forms again, and it just ended up being a huge hassle. So what I also do for myself, and you've seen this before, is I do track how I actually did, and so the column, what the result was, did it EW, expire worthless, or did I get assigned the shares? And like you can see that even if you get assigned the shares, you can still make money. So for example, for NPI, which is Northland Power, a utility company, renewable utility company, I promised to buy 200 shares at 39 bucks. And so I had to shell out $7,800, but the stock was just barely in the money. So I actually still ended up being positive on it, um, because I collected $257 there, and I was really in the red only by $12, I'm sorry, only by $12. Um, so the premium enabled me to be positive on the trade. Now you're saying, well, hey, but you had to come up with $7,800. But as I had said previously, you can just buy the option back, and therefore I would have still been positive on the trade. And that's what an options trader would do, is they don't want the shares, as I said, and they just want to make the money off the option. So they get out of them usually 3 days before expiry, or more, when the time value has gone down, but they just don't want the shares. So, anyways, now has anybody else joined us? I'm just gonna stop sharing. No, just still you and I. Excellent. Okay. Um, so let me kind of show you my process. So I do subscribe to a company called Options Play. They're they're a training company, and at the same time they have kind of a cool um uh, a cool call, yeah, just called Options Play, and that is for options traders. And so they help you with some of the technical analysis, and then they help you with the options trade. So I signed up with them 2 years ago, and they were offering a free Canadian version. For US, you have to pay. So I'm still able to do the Canadian version. I'm still able uh, to do it 2 years later for free. And so one of the things they do is they constantly have this available. I think pretty much anybody can access it, as far as I can tell. Let me refresh this. Can I refresh this? Refresh this. So part of my process is I want to sell these put options on stocks that I already own, meaning I'm familiar with them, and theoretically I am happy to get more of them today, because if I'm not willing to buy more, I should be selling the ones that I have. That's sort of how the philosophy goes. There's no holding. You should either be buying, or you should be selling. So at this point, I'm willing to buy more. Um, so this is just a machine generated list of kind of the highest returning options. So they give you the expiry date, they give you the strike price, and based on the middle value between the bid and the ask, right? The bid and the ask, just like stocks, they will calculate a return. So annualized returns, obviously, these are hilarious. Um, if you do get access to this, don't just start at the top. You'll end up getting crappy stocks just to get a high premium. The volatility is um, is what's one of the things that drives the high returns. Can I get some audience participation? Quick skill testing question. What factors determine the price or the premium of an option?
The amount of people willing to buy it. I don't know.
No. Well, to some degree, but I mean that will find some sort of a balance. But for options exclusively, it's three main things and then a couple of additions. The most important one is how far away is the stock price currently from the options price, the option strike price, I mean. Okay, so going back to Algonquin here, um, the the stock price is at, where are you? Is at $9.29, and the strike price is 10. So it's close, right? Now Mullen Group strike price is 15, and this is $14.92. So it's close, a lot closer than Algonquin was. And you can actually see that because of the time decay, I end up being positive on the trade, that I could get out of it right. That's kind of odd. Okay, I don't know how their math is working here. But anyway, so number one is the the first thing is how far are we in the money or out of the money? So if the strike price on the put is $10 and the stock dropped down to 3, the option is going to be worth a lot because it is far away from it's far in the money and it's far away from the option price. Conversely, if I sell something with a strike price of 8 and the current stock price is 10, then that option is likely not going to get me a heck of a lot. Okay? So that's number 1. Number 2 is volatility, which is why I'm asking. You can see the implied volatility here, and you can sort of see it coming down, 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 down. So that's the second thing. Some of the others, by the way, is dividends and interest rates. If there's a dividend coming, then that gets priced into the option. And the third major thing is the days to expiry. So how much time is left? So if you have a couple of days left, you're not going to get much for the option because there isn't much time for the option to get into the money. But if you have a year left, then the option is going to be worth a little bit more. Like I said, the time value starts falling more quickly. It's constantly falling, but in the last 6 weeks, it falls very quickly. But if it's a year out, then it's sort of going slowly, linearly, and then it really starts to plunge in the last 6 weeks. So that's why we're doing these, because the seller benefits from the time expiry. So the three things again: how far are we from the share price with the strike price? Uh, what's the volatility? And what is the time that's left before the option expires? Okay, does that make sense?
Yes, yes, it does.
Okay. I mean, you're right as far as the bid and the ask, but those are driven by the three factors that I mentioned. Okay, so what I do is I want to be doing this for, and this is just my strategy. I'm sharing it. It's not complicated, which is maybe one of the reasons I like it. And I think as you get experience with it, or with options in general and options trading, you'll develop your own strategies and you'll get your own favorites and so on. So what I do is I have a list of stocks here, and I copy and paste from their spreadsheet into here. And then I did a formula that basically says, show me a number in column D if you found the value in C in column A. So basically, have do I have the stock? So all of these, no, 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 no. Okay, so the first one I have is WCP, which is Whitecap Resources, energy company, oil company. Okay, I don't mind adding to it. So what I do is I go to Quicken and I look to see how much WCP I have. So Whitecap Resources is down here. It's like a 0.5% of my portfolio, so I'm still comfortable adding more to it. So I'm going to go ahead with the analysis. Okay. So first thing that I can do is I'll plunk it in here. WCP. And you can use, I'm going to use it for something else, but you can use Yahoo Finance or even your brokerage. Okay. And so looks like from a technical point of view, in 1 month they have a bearish and 6 months they're neutral. So I do use technical analysis for the option selling. I generally don't really use it for long-term holds, but because 6 weeks is such a short period of time, it is really um, difficult to use quarterly returns and balance sheets and income statements and so on in order to make a 6 week determination. So it looks like around $9 and maybe 40 cents. Looks like there's resistance and support. So you can sort of see over here we bounced off that, we bounced off it here again, here again. So we're above that. So I would be comfortable somewhere around $9.45. Now, what do they recommend here? WCP. So they're recommending about $9.50. So that's a little bit above. But so I'm keeping all of that in mind during the analysis. Now I'm going to be using it for income, and I'm going to pretend that I don't own shares. And they had recommended a February 17th expiry. So that's here. Okay. And they're suggesting a lower strike price at 850. So that would, where is it? They change this every so often just to make things difficult for me. So that would still come back with a 23% annualized return. and it would be high chance based on historical volatility, high chance of expiring worthless, which is sort of what I'm looking to do. So I'm going to keep $8.50 in the back of my mind now, and I'm going to go back. Okay, they changed this. Sorry, I have these boxes here because that's where account numbers show up in Interactive Brokers, and I was told not to display that on YouTube. Um, so we're gonna no February, and I'm gonna modify this, and I'm gonna say the 950. Hey, let's look at 925. Um, February 925. Okay, and so that's given me a much higher annualized return, but it's sort of 60-40 that it's going to expire worthless. So a lot better payout, but also a higher chance that I'm going to get the stock. If I'm okay getting the stock, no problem. Uh, but it looks like I'm a good ways down. Okay. So, I mean, I could change it to have the strike price at $8. I wouldn't get very much money, but there would be a very low chance historically that I would end up getting the stock, which is you sort of have to balance that, right? So I don't mind being fairly close to the money because I don't mind getting the stock so much. But so I'm gonna go for 925. Now the other thing we can do in here. So I'm gonna do Whitecap Resources is I'm gonna look at the historical. So I wrote myself a little macro. So what I'm gonna do is I'm gonna download historical prices and see how they do in January and February. So this is the raw data, and what I'll do is I will go to macros, paste in my code, run it, and it will kick out kind of a consumable January, February, right? So we're going for middle of February. So historically, January's been negative. This has been positive for February, so that's sort of inconclusive. It's not really giving me anything. Now, if we were looking at these 2 months where, what is that, January, February, March, April, and May, then that would be a different story. Um, so. So that one was sort of inconclusive. The other thing I'll do is I'll go to here. I'm doing this a lot slower. Than I would WCP. And analyst ratings. So there seems to be 6 analysts which are saying, hey, that's not bad. So I'm gonna go for it. So I'm gonna go WC Whitecap. options chain. So now up here, I don't know, can you see this okay? Otherwise, I'll blow it up a little bit.
Yeah, it's all good.
Okay, perfect. So there's an expiry, it looks like every Friday. I want the one that's 43 days out. So February 17th. Whatever brokerage you end up using, you have puts and calls. We're just dealing with puts. The current price is $9.86, and we're gonna do $9.25, so that's out of the money. Green is in the money, right? So for puts, if the put strike price is above the share price, then it's in the money. It's in the green here, and you notice how the prices come up. But when it's out of the money, really its only value is the time value. Okay, so I'm gonna do let's say I do six of them, six contracts, so that's 600 shares. So I'm gonna be on the hook for $5,400. Now here's the bid and the ask. For lightly traded options, it ends up being a bigger spread. I'm probably going to try to start in at 41 cents. It looks like they're moving. Let's go back to here so as not to ruin my. So you look for the 1 day. And 1 day. So it looks like it's trending upwards. That's for put selling. I would prefer it to be trending slightly downwards, because what I'm going to do is I'm going to put in an offer, but if the stock goes up, it's getting further away from the strike price, and therefore my offer is never going to get taken up. So it looks like it's sort of an upward trend today, but it's always from this point on, where's it going to go? So let's go back to here. And so we're going to do 925. I'm still not really used to the interface that Interactive Brokers is using. So we're going to be selling at 925. We're going to do quick math here. So I'm going to put in, what did I say, 41 cents. So I'm going to do 41 cents divided by the 925, the dollars per risk. This is per share, right? I'm going to collect 41 cents per share of the option, and I'm at risk for $9.25. And in order to annualize it, I'm gonna go times 365, and then I'm gonna divide it by the 44 days that we have to expiry. So I'm gonna be getting a 36% annualized return, which is not bad, right? Compared to anything else that you could be getting. So I'm gonna go order. I'm gonna, whoop, thank you. I'm gonna, what did I say, 6? See, this has moved since we last looked. It had come up, which is good because I can ask for more money. So instead of 41 cents, I'm gonna go for 42. Okay. So sell. Sometimes it defaults to buy for whatever reason. Your brokerage obviously will be different. By the way, Interactive Brokers is really good for options as far as fees. My Q trade was just murderous with fees, so something to keep an eye out on. I know it's convenient to do it in your regular brokerage, but I'll show you real quick with Interactive Brokers. Not only that, they were charging me a fee when I was selling them, but if I ever got assigned, minimum $45 when I got the shares. right? This was all Q trade. And then if I bought it back a couple of times, then the fees were even higher. So they were just terrible. I should have switched. And yeah, when I switched, look, no fees. So just something to keep an eye out on. I'm gonna do a quick preview. 42. I'm gonna get $152, and I'm gonna transmit the order. I always wait with bated breath. Nothing. See, it keeps going up. So actually, I could probably increase this to 43. The fact that this value is going up means that the share price is going down of Whitecap, right? You're clear on this. I get more money the closer I am to the share price with the strike price. Oh, see, there it went. So I got it. So I could have probably gotten more money, but what had happened is Whitecap. Let's just refresh this. No. Whitecap had gone down some, and therefore the options price went up, and somebody filled my order right away. So I made $252 right there, and now I'm on the hook for $5,400 and change. Okay, so that's one. I usually do like 6 to 8. So yeah. So I did 8 last time. I did even more I did 10 for the previous expiry. So that's one. I'll go a little bit faster now. Where's my Oh, I closed it. Well, that's not good. Okay, now I get to do that again. On the plus side, I get to refresh it. I tried to clean things up and I closed after that macro running and it shut everything down. Okay. So there's Whitecap. New Flyer. So they're a bus manufacturer. They've been having some issues. I think they probably still have about a year before they clear things up, which is, of course, when you want to buy them, is when they're low. Let's just take a quick look here. I think they will turn around, and looks like they've sort of begun. They don't pay a dividend, which is they cut their dividend. So I'm a little torn on them. I'm not that excited about them, so I think I'm gonna skip them. Do I have them in here? Hold on. Sometimes I use the silliest things. Oh, I do have them. Okay. Let's take a look at them anyways. So again, my strategy is just add to stuff that you already have and that you own and that you have a background on. So there's some optimism here from a technical point of view. What were they going to suggest? They were suggesting $10. And right now they are at $10.57.59. So if we go to February, Okay, that's weird. February and $10. So somewhat lowish chance of expiring worthless, but a 40% 40% return. So let's what are they, $10? Let's do 5. Let's do 5. And you can see Whitecap here with the February expiry right there. Proud new obligation. So let's do NFI. So it looks like they're drifting upwards. Options chain. And we said February 17th. It's super easy to mix up the expiry dates, which significantly changes the premiums. So, make sure that you're in the right neighborhood. So notice a little bit thinner traded. It's very likely these people are just market makers. They're not actual people. They're professionals who make money on the difference between the bid and the ask. Um, so that's why I sort of start in the middle. Um, if you choose a more frequently traded or bigger stock, you could you would be dealing with individual people, but here it's mostly market makers. So implied volatility 44% on this one, so still pretty volatile. It's not the over 100% like some of the ones at the top of that spreadsheet were. So it's a sell. February 17th, yes. Let's do 5. And let's say 0.43, right? Well, not right in the middle, but middle-ish. If it's heading upwards, I'm going to need to, if the stock price is heading upwards, I'm going to have to go back in and change the limit price. Nothing, nothing. I doubt there's somebody clicking a button somewhere. They just have systems set up where they have kind of the prices they want to deal with. Okay, so we're going to move on. We're going to leave that one sitting there and then come back a little bit later and make updates. Okay. So there's that. Algonquin. Okay, so Algonquin Renewable Energy and Utility Company, so energy transmission. They've been beaten up. I don't think they're a bad company. There is a possibility that they're going to cut their dividend, which may or may not cause another leg down for them. They sort of had a bad quarter with bad predictions, and they've sort of headed down. So what price are you suggesting? They're suggesting $9. So the stock is at 934, so really just below it. We're going to do that. Let's look at historical. AQN. Make sure you get the Canadian version. Again, go to historical data. Maximize. Max. This is the way I set up the macro to run on the monthly export. I could have made it to run on a daily, but since I'm really interested on a monthly basis, it's all good. Open that up. My macro. Algonquin. Run. What? Did anything happen? Nope. Okay, so there was an error somewhere in the data. I'm gonna try running it again, which, yeah, okay. The data came in a little bit different, I guess, than the macro was expecting. I'm not sure why. I'm not gonna puzzle it out now. So we're gonna look here. So, okay, so there's a hint of optimism that they've dropped far enough. What my approach with Algonquin is that if they were to cut their dividend, I would buy a whole bunch more. But otherwise, I'm sort of just gonna do. Um, I'm gonna do five of them, five contracts. So I'm gonna be on the hook for $4,500. So I don't mind sort of nibbling away at it. I am gonna get some more in 2 weeks in the January expiry. So let's go hit Algonquin. New York, TSX, okay. Options chain, 43 days out, and they were saying $9. So I'm gonna do 5. Let's put in the middle 42 cents. Complete coincidence that they're all sort of in the same share price area. They're obviously different stocks. Quick preview. So $210 is going to come my way. There is a commission, but it's what, $1.50 for a contract. No, $1.25 a contract. While Qtrade even then charged $1.25 a contract, plus they charge $6.95 or something. So even there, I'm saving money. So I have 3 brokerages, which isn't ideal from getting an overall picture, so I end up using Quicken. But I think it's important to sort of minimize the fees, and like I showed you, Qtrade was just killing me. So just make sure it's a sell. Submitted. Okay, so let's go look at our results. So we have 2 sitting there, which I'll go check in on, and this was the one that got filled, and I made $252 less $7.50. Let's check in on the NFI one. So we're at 43 cents. So looks like NFI is going up. So we're soon going to be out of the range. So let's modify it and still sort of put it in the middle. So let's say 40 cents. Quick check-in maybe. So 40 cents divided by 10 times 365 divided by the 43 to annualize it. So 34% annualized return. Not too shabby, especially if it's a stock that you think is a good one long term. Okay, so we're going to submit that, and
I'm not sure if I'm frozen, but it's just showing the Q trade page for me.
Oh, I'm on Interactive Brokers. I'm sharing my screen.
Okay, maybe I'm frozen. I'm not sure.
Okay, let me stop sharing. Restart sharing. And okay, are you on Interactive Brokers?
Yes, it is now, yeah.
Okay. All right. So we still got two are open, and still I only sold one. Okay. Now let's let's keep moving. This concludes part 1 of the Put Selling Live video. Part 2 is available in the end screen. I hope you found the session useful. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.